So I'd like to now invite the other set of panelist speakers. We have a panel discussion on the LP views on LP-GP communications, due diligence, and more. I'd like to invite, first of all, I'd like to invite Rajeev from Cactus, who's graciously accepted to moderate the panel. And please round of applause everyone for Rajeev and the speakers as we invite them. Next we have Ajit from Evolvence, Piyush from Stratford House Advisors, Unmesh from Julius, Baer, and Varun from EDEM Partners. A round of applause everyone. Thank you. Over to you, Rajeev.
Good afternoon, ladies and gentlemen, and welcome to IVCA's Maximum India Conclave. We have an eminent panel today, kicking off the first panel on LP-GP communications. My name is Rajeev Kalambi. I represent Cactus Venture Partners. We are an early stage fund investing across health tech, clean tech, B2B SaaS, and select consumer. Today we have an eminent panel which cuts across wide cross-section of the LP community, investing across stages, across geographies, across asset strategies. For example, we have Ajit, who's a managing partner at Evolvence India Fund, which is a fund of funds, and I will come to each one of them to share a little bit about themselves. We have Piyush, Jhawar, who is with Stratford House, which represents and manages some of CDC, formerly CDC, now BII, some of their funds, and is looking at doing something, raising a new fund on the secondary side. We have Unmesh Kulkarni, who represents the private banking and the wealth management community with Julius, Baer, and we have Varun Divgikar, who brings in the global hybrid fund strategies, to sort of opine on some of the interesting points that we're going to be discussing today. So what I'll do is I'll just hand it over to each one of you gentlemen to sort of share a quick 1 minute introduction on yourselves. Ajit.
Sure, Ajit, thank you. I am Ajit Kumar, managing partner for Evolvence India Fund. We are known as a fund of funds in the market. But we do fund of funds, co-investment, direct investments, and secondaries. We are currently on Fund 4. Been investing in India since the early 2000s. So we have seen a number of cycles, and very, very heartening to see the current environment where there is a startup ecosystem and a new mushroom growth of new fund managers in this ecosystem. I'm very happy to provide my insights.
So Ajit, just for the benefit of the audience, do you typically focus a lot more on the PE side, the venture side? What is the kind of preference that you have in your?
See, our DNA is PE actually. So we have been a PE firm, and over the last few years, as the market has seen success stories around ventures, we also sort of nibbling at some venture opportunities. So we are not necessarily very, very kind of seed or pre-series A kind of investors, which we do normally through few select managers. And anything series A and upwards, we look at for direct opportunities.
Thank you so much. Piyush?
Thanks, Rajeev. So Stratford House is an intermediated platform providing solutions to both LPs and GPs active in India, both through non-fund based advisory kind of solutions, which Rajeev mentioned. We are working with BII on that, and also through fund-based secondary solutions where we operate across the spectrum, ranging from transacting in LP books to GP restructurings and different forms of that. But the idea is essentially to work with the GPs and provide kind of tailor-made solutions suited to the specific requirements of the case.
Thank you, Piyush. Unmesh?
Yeah. Good afternoon. My name is Unmesh Kulkarni. I'm from Julius Baer. Julius Baer is one of the top Swiss private banking wealth management firms operating in India. Earlier, our entire team was Merrill Lynch in India, which transitioned to Julius Baer in 2015. Essentially, we look after managing or rather advising and guiding our HNI and ultra HNI clients, corporates, etc. on various asset classes, various products and instruments, and navigating through the market cycles. Traditional asset classes such as equities, fixed income, mutual funds, etc. But alternatives since the last 10-12 years obviously has been a focus area as well. On the unlisted space, just taking the last question forward, well, our focus has been more on the private equity side, the mid-stage PE space, etc. Venture, yes, we have done a little, but through the venture debt route, not really the venture capital part as yet. And of course, into other alternatives such as structured credit, a bit on the real estate side as well on the unlisted.
Varun?
Thanks, Rajeev. My name is Varun. I work with IDI EM. We are a French and Luxembourg-based fund of funds that invest across emerging markets like China, India, Southeast Asia, Latin America, Africa, and the Middle East. We've been active in India since early 2004. Have partnered with a couple of funds, made direct investments as well, and also look at opportunistic secondaries across different industries. We're a more traditional private equity player, but we are looking and opening our scope into early growth and venture as well.
Thank you, Varun. So I understand this is a post-lunch session, so I'm going to try and keep it as punchy as possible, and I'm requesting the panelists for a no-holds-barred sort of response to the kind of questions I ask. So kicking it off, let me start with you, Ajit, saying that look, GPs are aware of the kind of diligence that LPs do on them before they commit any capital. What are some of the key criteria that you'll look for in GPs, and what are deal breakers?
I think you should start with the last one then first, the deal breakers. Make it more interesting, actually. Rajeev, first-time fund managers have more struggle to raise capital as well, obvious reasons. There are investors who look for, investing, be it first-time managers or second-time or experienced managers in multiple successive funds. But when it comes to first-time manager, I'll start with that and get into the diligence part, actually. People want to see, a kind of a clear differentiator, because there are a number of others in the same market trying to raise capital. So, you have to be honest and tell your story, and that should resonate across the diligence process, basically. Because you say something and in the diligence doesn't hold, you are wasting your time as well as the LP's time. So when it comes to diligence, it's everybody goes through the standard process, and especially institutional investors like the pension funds or insurance companies or endowments, etc. They have a very stringent process of doing diligence if it's a first-time manager and first commitment, basically, even if it's an old manager. And they do everything, all aspects of the PE manager as well as, or the VC manager as well as the fund itself, starting with all the constituent documents, to the PPMs, to the periodical community, everything they do. But more and more what we see is, they also engage a third-party consultant to carry out operational background checks as well as operational, audits, etc. Because, as more and more fund managers are coming on board, there are lapses as well. So they want to see whether the firm has got certain, standards of corporate governance, and whether they are transparent in their, disclosures and communications. So, that is only going to increase, in fact, because as number of managers are coming on board more, the scrutiny of in the diligence process will keep on increasing.
Okay, so you're saying there's sometimes a little bit of a gap between the representation and walking the talk. So there's a, between what is sort of pitched and when you do the diligence, you have to ensure that there is a matching. So Varun, I mean, what has been...
And if I may add one more point over there, in the US there is an expression called jam with a double M. Just another mid-market buyout.
Okay.
So one should try to avoid that scenario.
Right. Okay. Varun, what has your experience been, in this example that Ajit has mentioned, saying that sometimes there's a disconnect, at least between what the fund professes to do and the diligence when it is conducted. What has been your experience when you all do your diligence on companies?
No, that's a very interesting question, and yeah, what Ajit says has turned out right more often than not. It's quite important that fund managers are always honest. Obviously, they always are. They claim to be, but it's also important that they stick to the plan. Sometimes what you see is what you don't get, and it's completely fine for you to change the strategy midway if you think that the market has changed or if there's been something that's been out of your control. It's good to be open about it to your LPs, because at the end of the day, once an LP loses trust or kind of sees something's missing, that suspicion always remains. And you'll keep getting asked more and more questions. So it's always better to be upfront about it. And at the same time, make sure that your LP is comfortable about things and you're not doing something that's completely out of the ballpark. I know fund managers don't do that, but always try to have an update call with the LP or with the investor relations persons from the other teams and convey what your plan of action is. I think that's important.
And LPs tend to be skeptical, in nature. So you've got to make sure that, whatever you're telling them, you sort of stick to that. So Unmesh, let me come to you because you represent high net worth individuals and, industrial families and stuff. So, is there a slight difference in the way you all go about doing your diligence on companies, and what is it that, is a deal breaker for you all, or is the, sort of timelines different? Can you throw some light on that?
Yeah, because we represent a lot of HNIs and ultra HNIs, and a lot of them depend on us in terms of guidance. So typically, if I look at due diligence, I would look at it as in two parts. One is when you do at the time of onboarding, let's GP or private equity fund also. And obviously, everyone has their own framework. We have also our own framework on multiple things. I think at the outset, there are certain things that at least I consider of paramount importance. One is the industry in which you are operating, whether that company or whether the fund, the underlying focus, whether the industries are or the quality of the businesses, whether they are sustainable in the first place. Because what happens is typically, and this is an industry of optimism. Obviously, it's an industry of growth, optimism. A lot of assumptions are made around optimism. So that is one thing which is very important, whether we are looking at sustainable businesses. And I also consider, and we consider the team as a very integral part. Many times we find, and these are all long gestation products, funds, 8, 10, 12 years. And many times we find that the original team, the strength, disintegrates over a period of time for different reasons. And that makes things complicated for everyone. So I think that's also important. There's a very strong chemistry between the founders, the employees, etc. The other point is the second part of the diligence is through the life cycle, and we strongly believe in this product life cycle management, because the fund has now raised all the monies, the fund has invested the monies, but what happens is typically over the period assumptions change, the assumptions which you came in with, they change, and circumstances change. Some companies, underlying companies do well, some don't. And that's where it's very important to have a proper GPLP sort of chemistry there to navigate the entire life cycle of the product. It's not just sufficient at the beginning, but at every stage. I know there are quarterly communications or half-yearly communications which come, but it has to be beyond that, because many times what happens is you hear of a problem when it hits the press. It's not necessarily, despite the best of the relationship between the LP, GP or wealth managers like us and the funds, etc., you often hear of problems from secondary sources. So it's important to have that chemistry.
Right. No, thanks. We were sort of segueing there into the communication side of thing, which I would like to come to later. So maybe Piyush, given the the fact that you're raising a sort of a secondaries fund, and you also are looking at a lot of your existing portfolio companies and stuff, when you diligence, say for example, their MIS, right? And GP restructurings and stuff, and that's something that I would like to come to Varun to as well. Where does it fall in terms of the quality of the MIS that GPs today have? So, for example, when you go into diligence a certain company, if you had to rank the data that you're getting from them that they have got and sourced from their LP, their investments over a period of time, where would you rate it from on a 1 to 10 basis, and where do you think there could be some potential improvements from a diligence perspective? Yeah.
I think it's a very wide range. It's hard to kind of categorize and rank per se. But secondaries is not a kind of a standard product anyway. I think the information there is tailored to the kind of stuff you are looking at. So if you are looking at an LP book, the data there will typically be all the information that they receive from GPs, which again varies by a large degree. The quality of GP reporting is very different. Some go into details of the operations, etc., whereas of the underlying companies, whereas some report just bare minimum information, which they are regulatorily or by agreements supposed to report. But when it comes to GP-led situations, I think one has to categorize the information in 3 primary buckets. I think one is relating to the portfolio, where you get information on the underlying investee, because that's where the bulk of the analysis goes. Second is around the constitution of the vehicle, etc. So the LPAs, the policies, valuations, etc. And third, obviously, is on the transaction structure. In terms of what we have seen where the preparedness of the GPs is concerned, I think having spent a considerable time at CDC or BII now, where we used to look at a lot of first-time funds, and a lot of work that we used to do was essentially create capacities within those managers. So we ourselves have worked towards creating data rooms with those managers, because part of our mandate was not just to invest capital with them, but to mobilize other capital. So, and we are kind of open to doing similar stuff there as well, where we help managers prepare for these kind of things. GP-leds are not very common still in India, so not many people have that experience. So it requires a lot of hand-holding, and that is a part of the manager selection process as well. Wherever we see any reluctance to transparency, that kind of raises red flags upfront. So I think openness is very important, and transparency is something that we rate highly.
So we'll come to the communication side of things. So Varun, any insights on how well MIS management has been done by GPs globally versus India? Are there learnings that Indian GPs could take from best practices globally, or do you think that Indian GPs are almost at par with international benchmarks?
No, coming to this point, I think there are 3 key areas when it comes to reporting MISs or quarterly reports, annual reports. I think clarity, conciseness, and credibility. I think these are the key 3 things which are, they sound very simple, but it's quite often than not that a lot of GPs mix them up and don't stick to the plan. As an LP, obviously we're managing multiple lines across multiple funds. So having too much information also at times doesn't give us a chance to actually go into all those details. For example, sometimes one of the portfolio companies may have reported a bad quarter, and the manager may give a very big rationale for that. It's fine, but you should look at it from your LP's point of view as well. That's what I always like to say. We always do a KYC, know your customer, but you should do a KYLP, know your LP as well, because we have limited time. We have limited time to look through all the portfolio details. We trust the GP at the end of the day. So it's not that we don't trust you, but also going through that amount of information takes some time on our end, and again compiling it and sending it across to our investor relations and our LPs also. You kind of don't want to spend too much time into those details. So keeping things concise, I think in terms of best practices and comparison with global other funds, I think Indian managers are quite transparent. Comparing them to the Chinese managers that we've come across, I don't want to comment too much on that, but yes, I think transparency, as Piyush said earlier, is a key criteria. Once we find that some amount of transparency is missing, that's when red flags are raised, as again Piyush said earlier, and that's when we kind of keep trying to dig out more information. In many cases, it's not the case that maybe a misstep in reporting or information, but I think just being open, having a channel of communication open with your LPs is something that would be advised to GPs. And Indian GPs, I think, are doing a great job on that front. But I think they are at a good level, good enough level when it comes to global reporting standards.
So the key takeaway here is provide a data room, not a data dump, right? And the second is KYLP, right?
Exactly, yes.
Yeah, know your LP. I think that's important for the GPs out there. So then what is it that excites you when you look at a fund? The differentiator is one thing, and what I would like you all to share is the softer aspects of it. Because we know that, okay, if it's a second time fund or a third time fund, they have a track record, right? Which is a financial thing that you can look at. You can look at the DPIs, TVPIs, etc. But on a softer side of things, what is it that you all appreciate in GPs that you would like to sort of put money into? Go back.
Just before that, Varun, I think the reports are in Chinese, possibly, that's why. Anyway, see, when it comes to first-time managers, in the hedge fund industry, there is a practice to commit money to first-time managers. The reason is, these managers have worked in a firm which has been quite successful, and they have been generating good returns. But these guys have identified some, ideas there or strategy there which will act as a differentiator and maybe less correlation to certain factors or other returns and can generate better returns. So they come out and try to sell the strategy basically. But above all that, for the first time manager, what stands out is that the burning urge to perform basically, because there is more hunger in them basically. And we have seen that in the hedge fund industry, the first-time managers have outperformed existing managers, basically. There is record to show. So people started committing at least, small amount, or some of the institutions started, backing those managers. When it comes to venture capital and private equity also, I think it applies the same, basically. You have to tell the story, what you have done. Stick to your story, basically. I say again and again, and so that the investors have to get the conviction that these guys can deliver from your earlier track record or the kind of differentiator strategy you are talking about. So I think your own way of narrating your own true story. Possibly, there could be interest from investors.
Any other insights that you all would want to share? What are some of the softer aspects that you look at when looking at certain funds? Maybe I'll ask Unmesh to sort of throw some light from the individual investor perspective.
So I would say three things. One is an innate entrepreneurial instinct in the GP, in the type of companies that they evaluate as well. To essentially, as I said, this is completely it's a venture, a business sort of area, and ultimately it's aspirational capital. So unless you have that hunger or the entrepreneurial instinct, you're not bound to really succeed too much all the time. So that is one. Second is strong risk management. No matter how optimistic you are about the industry, about the company, etc., whatever, but you need to have strong risk management processes, strong controls in place, just in case any of your assumptions go wrong, and sometimes you may have a bad company or a bad promoter, etc. How do you deal with that, etc. And third is a very clear exit strategy, is what I would look at, because we have seen the best of the money gets frittered away if you enter a wrong cycle at times, and a smart manager, a smart investor is always one who knows when to call it a day and move on in life.
Piyush?
I think one very important aspect is now the Indian private equity ecosystem has evolved to a certain degree from the early days of early 2000s when the annual volumes used to be about $1 billion or perhaps less than that to about $80 billion now. One has to see whether the strategy is something that reflects their core strength or niche or whether they are just being an opportunistic Me Too player. I think that distinction people need to bring into picture. And that is critical because we saw in late 2000s a lot of people went into infrastructure because that was the buzzword then. Today we see so many of these VC funds coming up because everyone wants to be in unicorns and things like that. So therefore, past track record and how relevant it is to the next strategy that you are looking to do rather than being opportunistic Me Too is critical, I think.
Varun, do you have any insights here?
Yeah, just great points. Just one quick addition. I think skin in the game and alignment with LPs. I think as LPs, we are your partners, and we also want to see. I mean, we want to be happy when you're happy, and we want you to hurt when we get hurt as well. So I think having enough of skin in the game and alignment with your core strategy is something that we consider quite high up in the ranking order of things. And obviously, there's track record and everything else that people say. But yeah, skin in the game, I think, shows that you believe not only in yourself and your fund strategy, but you're ready to share the pain and gain with your LPs.
That's an interesting, and it ties into what Unmesh mentioned about the entrepreneurial side of it. Right? So the entrepreneurship and the skin in the game together sort of combine to convey to investors that you're serious and you know what you're doing. Right? Okay, moving on to the communication side. Now this was the diligence side of things. Let's now say that okay, we've invested in your funds and you've got a portfolio. Let's start by asking, okay, how much should and what are the elements of the communication that you would want from a GP? Now you do have your quarterly reports, you do have your NAV statements, you have your annual reports, you have board meetings that you do, LPAC meetings that you do. So in addition to that, and I would like to tie it to what Unmesh mentioned about the fact that you find out only when something goes wrong. So where is that balance that GPs need to maintain? Can you throw some light on that?
Yes.
Ajit, yeah.
Besides all these quarterly reporting plus periodical communications, etc., I would always advise the fund managers when something goes wrong, be proactive in communicating. Because rather than the LP hearing from someone else and calling up the fund manager, it's better to hear from the horse mouth itself. Because otherwise speculation and you don't know what all things happen, then there will be in this age of social media, so many things can go wrong. So a proactive communication when something goes wrong, because you see, in the investment world, you cannot expect every investment to do well. Something might go wrong. But it's important to understand how the manager has addressed the issue and what are the lessons learned from there and how the manager is integrating that into the firm's strategy and governance standards, basically. That will give more comfort to an LP, actually. So proactive communication when something goes wrong is very, very, very important, apart from the other regular communication which is going back and forth between the LP and the fund manager. Of late, the online access to GP, to LPs on the website is becoming more and more fashionable. But what I know is from some survey that only 50% of the fund managers provide such online access. It is essential that managers provide such access in this time of internet and digital services, and also again to the point of not to dump them with so much of information, but to the extent they need for all their understanding and accounting and reporting purposes. If they have any queries, obviously, you can have a provision to call up and ask for any more details they want. So stick to a kind of an optimal level of giving information rather than dumping too much information which may get lost in transit or translation.
Okay, so what essentially you're conveying is that LPs understand that things can go south and you'll are okay with that. You'll understand it, but you'll want to know what the GP is doing to resolve the problem. But in some of my communications with a lot of other GPs, we find out that they're a little aware of, or rather they beware of sharing, when things are not very good, because they start thinking that, look, maybe I can turn things around, rather than if I share the information a little too early, I will have the LPs breathing down my neck. Now where does everyone stand on that?
No, let me just look on that before I hand it over, since I started that. What happens is, even if it's too early, I'm not saying that very, very early you inform them. When you have clarity something has gone wrong, it's better to inform them this has happened, but we are working on it. This could be the possibility. If it works out well, if it doesn't, this is the chance, but we are trying to do everything as possible as we can. That will go with, that shows honesty and transparency in reporting, because anything can go wrong. This is an illiquid investment, meant for 5, 6, 7 years, at least one investment alone. So anything going wrong, because that kind of risk is always there in a private equity venture capital investment. So this will give you trust among investors. So that's essential. Go communicate proactively what went wrong and what you have done to address that, basically.
Right. No, that makes sense. So Unmesh, you brought up this point, saying that we find out only maybe say from public sources or when things have completely gone to pot. But when you all are doing your diligence and the kind of information that you want, historically we've seen that, at least the institutional LP community understands these things, as Ajit mentioned. But do you face challenges from your clients when they are looking at the unlisted side, and anyway it's relatively non-transparent from an NAV perspective when they're looking at comparing it with the markets, and when they start hearing that okay, some things are not working out, what is their response, and how do you deal with the portfolio side of things and your client's side of things?
Oh, absolutely. I think from the GP's perspective, I think the character of the investors has been changing over the years, and they're also learning from that, because initially they were used to dealing with only institutional investors, and the entire communication, whether verbal, written was aligned in that direction. But over the years, over the last 15, 20 years, obviously a lot of non-institutional fundraising has been done by the GPs, and that's where many of these, when they talk to me also, I guide them that, look, you are getting a different, from your neighborhood river, you're now getting into sea and the ocean, because this is a huge ocean of investors. So first of all, what the GPs need to understand is keep the expectations low. What happens is, during the fundraising, etc., you're keeping the expectations very high, raising the expectations of people that everything is hunky-dory. So you have to keep the expectations low, and then manage those expectations, and therefore having the right amount of people who can talk to, let's say, the investor community, the HNIs, ultra HNIs from time to time, maybe have more organized calls with them, because many a times it goes on to one-to-one discussion, which is not sustainable on a large scale. That's the second thing. And I think what is more important is to give out pertinent communication. Because many times even when you see the quarterlies, a lot of financial information which many institutional investors will understand, but non-institutionals may not necessarily understand, comprehend. There's a lot of marketing information which is given about the underlying investing companies, but how the scenario is unfolding, what are the successes, or even the sort of the failures, those are not adequately highlighted. So timely and pertinent communication is essential in order to manage the expectations. I think the fund managers, they're all learning, and we have seen considerable progress also over the last few years, and as more and more people are raising monies through non-issue. But mind you, it's always going to be challenging, because unlike institutional investors which have had experience of investing over cycles, the risk appetite, although everyone knows that this is the riskiest form of investing, but actually if you ask me, the ability to or the willingness to lose money in even, let's say, 1 out of 10 underlying companies is very limited. So it's a little bit of hand holding, and a little bit of timely communication helps.
Okay, thank you. So I think the takeaway which I got is that one of the questions I was going to ask is, in addition to the frequency of reports and everything, what can GPs do in addition, to ensure that there is effective communication? And one of the points which Ajit mentioned was that, make sure you may have an online presence where you can answer a lot of questions with access to the GPs. Another thing you've shared is that, maybe have, a sort of like a conclave like this, get all your investors together, maybe online, and share and have a two-way communication with all of them to manage numbers. So those are maybe some takeaways. Any other suggestions, Piyush? Do you think there's something
I think
they can do better?
What Varun said was quite important here, that know your LP. So there are certain investors that are purely focused on, in fact, all investors are focused on financial returns, but if you have people like DFIs in your fund, then certain non-financial aspects also matter a lot to you, to them. So therefore, communicating on those incidents proactively is important, because they have their own reporting system to manage as well. They are answerable to authorities within their own jurisdictions. So it just helps them prepare ahead of things before things hit the press and you hear from secondary sources.
Right. So in fact, one of the points is that it's not just the outcome of something, but it is how you have managed the process and what you're doing to counter the challenges. Is that it?
See, what happens is, when there is a very successful exit, the manager is eager to report immediately. Isn't it so? Why is it not the other way around? So anything can go wrong. Okay, sometime, in a portfolio company, something happened, the entrepreneur is knocked down by a car, but inform the GPs, the LPs about it. Don't hold back.
Right. So, and anything else in terms of the process, right? When you all are looking at it, what is it that, okay, let's imagine, a negative outcome on one of the portfolio companies. I think Ajit has touched upon it a little. Maybe, Varun, you could share something more. And what is it that you would like GPs to get back to you with in terms of, succinct information, which will address a lot of the queries and concerns that you have?
No, I think as it's not a best practice, but something that I've started doing recently, and this was just post-COVID time, was to every quarter try to have, from the LP perspective, have a quick 30-minute call with someone from the GP side. It could be someone from the IR team or deal team, just to get a quick lowdown on the portfolio at a high level, because you also need to understand sometimes the GP may not include all the information, and when I say all, it may be some information that can be included in the reporting files. So it's better to just get on a quick call, walk through the portfolio at a very high level. And I think the key areas to look at is there been any major change in any of the multiples of the portfolio companies, why that has happened, and what they're doing to handle it, rather than kind of going through a 10-page report and then finding at the last line saying that, oh, this is what we're doing and this is actually what happened. So having a quick call, again, it's informal, but it also holds the GP accountable to the information being shared. I think that's a quick and efficient way of getting to the bottom of things, both when things are wrong and when things are going as normal as well.
So thank you. At this stage, I think we've we've used up the allocated time for us, and thank you so much for your insightful comments. Does anyone from the audience have any questions at this juncture? Any questions? No? Thank you. Thank you so much, gentlemen. And I'm sure, people will sort of reach out to you if they want to sort of interact on anything else on these topics. Thank you so much.
Thank you.
Thanks,
Rajeev.
Thanks.
Bear with us for a few minutes. We'll soon be live. Okay. All right. Thank you, sir.